Look, I just sat through 2 hours of Millionaires talking about money, and I've got to tell you, half of what they said can make you wealthy, the other half could wipe you out. Let me break down what actually matters for your portfolio right now. My name is Preston. I built an 8-figure net worth from scratch through multiple asset classes, and today I'm going to show you exactly what these millionaires got right, what's complete nonsense, and most importantly, what you need to be doing with your money in 2025.
So what do you think the biggest money mistake the average person makes is?
Being a saver.
So just having your money sat in a bank account?
Yeah. So he's saying that being a saver guarantees you're going to lose money. Now look, mathematically, he's absolutely right. When your bank pays you 0.1% and inflation is running at 3 to 4%, you're not saving, you're slowly going broke. But here's what they're not telling you. Not everyone's ready to invest tomorrow. You know what happens when you invest money that you need next month? You start panic selling at the worst possible time. And I've seen it thousands of times. So here's my framework. First, get 1 month of expenses saved, just 1 month. That's your psychological safety net. And while you're building that, educate yourself. Open a brokerage account, learn the mechanics, and then this is critical. The day you hit that 1 month buffer, you start investing. Not next week, not when you feel ready, that same day. Even if it's just $50, the hardest part isn't the amount, it's just starting. Keep building the emergency fund while you invest. This isn't an either or, it's both and. The real problem isn't people saving, it's people waiting for enough to start. There's never enough. Just start small, stay consistent, and compound your way to wealth.
So Bitcoin, for example, since 2012, it's produced about 145% a year returns. There's no asset in all human history that's ever generated as much wealth. And because it's not a random thing, it's actually a technology and it's a network. As more people use the network, and we see with Bitcoin, governments buying it and asset management firms buying it, everybody else, you have this network adoption. And so what it creates is the same chart as Google or Amazon, all of these, it just goes up in a log trend over time with some volatility.
Now they're tossing out these huge numbers like it's a coupon code, right? That was the early tiny base math, and I don't anchor to that. The real signal is the adoption curve and the monetary design underneath it. Here's where I'm at. I'm a huge Bitcoin believer. Now the thing is, volatility doesn't bother me. Being forced to sell does. So I build my life so I never have to sell. I dollar cost average every single day. I self-custody. I don't use leverage, and I don't borrow against my Bitcoin, at least not yet. If price gets cut in half, then I buy on schedule. If it doubles, then I buy on schedule. I'm not hunting tops and bottoms. I'm keeping my coins through the trend. Now, if volatility freaks you out, you're looking at the wrong clock. You want to zoom out. Bitcoin moves in cycles. Over a full halving cycle, roughly 4 years, and there's big drawdowns and have historically been bumps on a road that keeps climbing. The goal isn't to outsmart every single swing, it's to survive them without breaking your rules. Volatility only hurts if it changes your behavior. If your plan is automatic and your living expenses are covered in fiat, then red candles just mean cheaper sats. And that's why I'm willing to sit on that volatility. Now, Bitcoin is different from other cryptocurrencies. There's credible scarcity, there's 21 million hard cap, halvings that cut new supply, and there's no committee that can dilute you. It's decentralized and neutral, and there's tens of thousands of nodes enforcing the rules. Settlement is global and is permissionless, and value moves in minutes, and you can audit the chain yourself. It's portable, divisible to tiny fractions, and you can hold your own keys, and so there's no counterparty risk unless you choose one. Now, none of that matters if you blow up with bad structure. I size my position so a 50% drop doesn't touch my mortgage or my sleep. I keep a cash runway so I'm never a forced seller. I don't have any loans against volatile collateral, and I write my rules, buy daily, don't sell for living costs, and rebalance only if I have to, and I follow this even when it's uncomfortable. So when you hear 145% a year, don't think lottery ticket, think network adoption meeting fixed supply. The swings are the fee to own the scarcest, most portable monetary asset we've ever had. Build a plan that survives the swings and keep your coins and let time do the heavy lifting.
In fact, I say 98% of America should not be active investors. Just be a passive investor, because if you don't want to put in the work, if you're not willing to put in the time and the effort to research, you're probably going to lose.
All right, so he's saying that 98% of people should just buy index funds. I push that to 99%. You know who should pick stocks? People who read 10Ks for fun. People who understand DCF models without Googling. That's maybe 1% of investors. But everyone else, you're not investing, you're gambling with the brokerage app. If you go and buy a stock because you believe in the company, that's literally just hope, not analysis. Here's what actually works. You buy the entire market through an index fund. You own Apple, Microsoft, Google, plus 497 others. And if one fails, then you got 499 backups. But here's the key. Index investing only works if you never sell. Not during recessions, not when your brother-in-law makes millions of dollars on meme stocks. So my rule is I only sell index funds for food or shelter. Everything else, I just figure it out. That constraint forces creativity and protects your wealth.
Money is the medium of exchange, the thing that you buy something with. If we all have a lot of money and you want to sell that mug, we can pay anything for that mug because we've got a stack of cash. So that mug suddenly is worth not the $10 it's supposed to be worth. It's suddenly we're paying $150 for the mug. Why? Because that money has no value to us because we've got excess money. So when you create excess money in the system, it's this debasement of currency. It's an optical illusion that the value of assets are actually going up. They're not. The value of your money is going down.
I like this mug analogy here. Assets didn't go up. Your measuring stick just shrank. But here's the part that actually moves the needle. You want to first start thinking in real terms. I price big goals in today's dollars, and then I add a debasement buffer. If I need $1 million, I plan for 1.3. I also sanity check in scarce units. So I ask myself, how many Bitcoin is that? So that way I don't get fooled into nominal numbers. The second thing is to renegotiate your income like an investor. Your annual raise target isn't 3%, it's inflation plus your productivity. So let's say CPI is 4% and you grew revenue or output, ask for 6 to 8% and then show the receipts. And if you're a business owner, build dynamic pricing into contracts, annual CPI plus adjustments, and shorter renewal cycles so that way you're not eating cost creep. The third thing is to structure debt to let inflation do the work for you. I only take fixed rate debt on productive assets and I never use that to consume. I don't overpay low rate fixed loans if I can invest at a higher real return. If rates fall later, I refinance once and then shorten the term and keep the payment near what I'm already used to. Variable and teaser rates are how you donate to the bank. The next thing to do is to redesign your cash system. I keep 1 month of expenses in checking, the next 2 to 5 months in short duration, low risk yield, like a high yield savings account, and then everything else beyond that goes to scarce, productive assets like Bitcoin, real estate, broad index funds, etc. The goal here is never being a forced seller while refusing to hoard melting ice cubes. The bottom line here is to price in real terms, lock in fixed costs, and then automate buying of scarce assets, and then let inflation quietly destroy your debt while your assets compound.
But do you think that if a 25-year-old puts their entire salary and savings into Bitcoin and they lose it, let's say they run through a 70% drawdown, aren't they just putting themselves in a bigger hole for their future as well?
The most important part of financial markets is the least understood is time. It's not just price, it's time. So if you're 25 years old and you get wiped out, you can do that several times when you're young and it's okay. You just don't want to do it
At
when
age
you're
50.
At age 50.
Sure.
People are so screwed. They are coming out of university with massive debts. We looked at the stat earlier. Percentage of 30-year-olds who have a mortgage and are married has gone from 52% in 1950 to 12%. Nobody can afford anything. So if you look at the average millennial in the US and a Gen Z, they generally have a 401k if they've got a job, right? They have some sort of savings, but they're taking massive amounts of risk.
He says if you're 25 and you get wiped out, then that's no big deal. You've got time. That's how you create a generation of bag holders. When you blow up at 25, you don't just lose money, you lose nerve. 5 years of second guessing or revenge trading is the real cost. Here's a smarter play. Don't just max out your risk and then max effort. Work 2 income streams, live light, and automate investing with a plan built to survive volatility. I'm a Bitcoin believer, but I don't worship risk. If you're 25, do this. Lock a floor. 1 month of expenses in cash so you're never a forced seller. I'm not saying that you shouldn't give yourself a sandbox, like a small slice you can experiment with guilt-free. If it 5x's, then that's great. If it goes to 0, then your life doesn't change. That scratches the itch without detonating the plan. And then run a 90-day skill sprint, like pick one high-level skill, AI tooling, performance marketing, sales, etc., and then monetize it as quickly as you can. More income beats more risk. You don't need moonshots when you're stacking $1,000 to $2,000 a month in your 20s. And then 8 to 10% over decades, that math is life-changing money. The bottom line here is to build a system that never puts you in a position to sell your best assets at the worst moments.
So if I buy something, whether it's an ETF stock or whatever that's paying a dividend, or a rental property that's putting money in my bank account every single month or year, that's money I can use to buy food, go on a vacation, do something. Here's what, let me tell you.
You're getting paid.
Listen, so
Nobody cares.
I started buying Bitcoin at $3,000 a coin. I went through multiple crashes. I remember when $20,000 of Bitcoin was oh my God, we did it. And once it hit around 70,000, I looked at this and I said, wow, I have my real estate, my stocks, my speculative, which is crypto and startups, and a 2% gold, which is now looking extremely inflated. I need to lower this. That way I can have some more income. So what did I do? I sold some Bitcoin. I bought rental properties. That now rental property is putting money in my bank account every single month. The Bitcoin, it's a big number on paper, but it doesn't actually mean anything unless I do something with it.
All right, so I think they're missing the point here. Dividends are psychology. When markets dump 30% and your screen bleeds red, those checks are proof the business still works. It's cash without selling the shares. That's the difference between panic and patience. Here's how I use it. I run 3 lanes: growth for building wealth, dividends for stability, and then a small speculation sleeve for upside. Roughly 60, 30, 10, depending on the season. Dividends won't make you rich by themselves, but they keep me invested through chaos, which is how I get rich. I keep it simple and strict. I auto reinvest by default, so I put drip on, so the payout buys more when prices are down and then less when they're frothy. If volatility hits my income and I need breathing room, then I can flip drip off temporarily and then let the cash stack instead of selling shares into weakness. And selection matters here. I'm not just chasing yield, I'm screening for durability. I want boring companies that have raised payouts for decades with healthy free cash flow coverage and a sane payout ratio. That way the check survives recessions. Typically anything yielding 8 to 10% is usually a trap. I'm happy in that 2 to 5% range if the dividend grows every single year. The bottom line here is that dividends aren't my rocket ship, they're my seatbelt. They keep me calm while my growth sleeve and Bitcoin do the heavy lifting. Calm investors hold and then holders compound. That's the entire game.
Well, I don't think most people know that they can leverage their crypto.
That's right. You can borrow against it.
So anyone can. You don't need to go to a bank.
No, you can do it instantaneously. There's a whole bunch of companies that do this, where you can borrow against your assets. You can even do it against digital art. Much like the art market, you can actually go and borrow against the value of the art, maybe 40, 50% against the value.
For someone that's like never even bought a Bitcoin before and is thinking about potentially buying one, but they would also like some way to have a little bit of cash.
Look, I don't like it, but the issue is you've got an asset that does this.
It's volatile.
It's very volatile.
So you can get interest on your crypto.
Yes.
Essentially.
And then if you're you're a little more sophisticated, a little bit racier, there are then yield enhancements. So we talked about high yield bank accounts. There's high yield versions in crypto, and you can get up to 20, 30%, but now you're taking risks.
And I can also loan against my Ethereum. So I actually did this at one point. I don't do it anymore, but I had 1,000 Ethereum and I took
$1,000 or 1,000
Ethereum. Yeah,
Oh my gosh.
yeah, I know. I switched it into Bitcoin a little while ago. So a couple of months back, but probably bad timing. This is why Melanie
That was
always
terrible
beats me.
timing. You should have called me first.
I know.
All right, so they're talking about crypto loans like it's free money. That's how people go from crypto rich to actually broke. Here's a real sequence. Let's say Bitcoin rips to $100,000. You borrow $50,000 at a safe 50% loan to value. Now you get a drawdown, and now you have no Bitcoin and you still owe the cash. It's game over. Easy money is expensive money once liquidation enters the chat. Liquidation triggers don't care about your conviction or even your time horizon. My rule here is simple. I never borrow against my volatile assets. Not Bitcoin, not stocks, nothing that can drop 20% overnight. If I truly need cash, then I sell a slice on my terms. If I can't bear to sell it, then I can't afford the thing I'm trying to buy. The only time I touch leverage is against stable assets I control, like real estate with massive equity and fixed terms. And even then, I underborrow and then I model ugly scenarios and make sure a bad month can't force a sell.
These days, with how the economy is set up, don't forget, when I was 24, 25, I was working in an investment bank. I wasn't the highest paid guy there. I was a 25-year-old. And to buy my first flat in London was 3.5 times my income. That equivalent flat and the equivalent income is 12 times. Rent makes much more sense now, and you might as well invest. Buy all the stuff that you think will drive returns. But a house, a primary house, is not an investment, never will be.
I was reading a New York Times article that just came out yesterday, and it said more millionaires than ever are renting in the United States, and that it's tripled between 2019 and 2023. Just a couple of years, millionaires are choosing to rent more than ever before. What's going on?
My guess would be a lot of the millionaires are probably living on the coast because they invest a lot or they have higher paying jobs. And maybe it's slightly unaffordable for them to buy a house in, say, San Francisco, Seattle, New York, Los Angeles.
In the New York Times article, it says they're choosing flexibility and liquidity over ownership, and they don't want to be bothered with the inconveniences of home ownership, which includes paying a real estate tax and insurance, especially in markets like Florida and California, where we're seeing a lot of natural catastrophes.
They all say that your house isn't an investment, and they're right, just not for the right reasons. You can't sell it without being homeless. So it's consumption with a side of equity, not a true cash flowing asset. Here's how I treat it. Housing is a forced savings with leverage. If you're bad at saving, a mortgage can create discipline. But don't confuse that with investing. Real investing either can pay you or can be sold without blowing up your life. Your primary house does neither. So I buy the lease house that makes me happy, and then I invest the difference into productive, scarce assets. Then I make sure to check the buy versus rent with one rule. If the price to rent ratio is over 20, let's say annual rent is less than 5% of purchase price, then renting usually wins. If it's under that, then buying can make sense. If you do buy, then take a 30-year fixed rate for flexibility, but don't serially refinance. If rates drop, either refi once into a shorter term or ask the lender for a recast after a lump sum principal payment, which lowers the payment, there's no restart of the 30-year clock, and then make one extra principal payment per year. That way, you'll chop years off the loan without touching your investments. If you have PMI, make sure you take care of that as soon as possible with a targeted prepayment and a fresh appraisal, and also audit the property tax assessment and appeal it if it's inflated. Raise your insurance deductible to cut the premium and shop it annually. And if you want the house to behave more like an asset, then you can house hack a room or a basement or an ADU, so that way the property gives you some of the cash back.
This word passive income, I know.
It drives me nuts.
Why does it drive you nuts?
There's like a passive income industrialization complex that is, it is literally every millennial's dream is, I'm going to get passive income, and it doesn't exist. We talked about property. Property is the least passive income you can imagine. It is awful. Every time I've tried to rent out property, there are so many costs. Everything goes wrong. It's just endless. You're paying fees, and people think there's a magic passive income. Everything comes with effort. There is no such thing as returns without effort. But even robbery comes with effort. There's no way of making money without effort or risking something. And so when you're 40 grand in debt, how on earth do you think passive income is going to rescue you? But he's seen that on TikTok and on Instagram. Oh, we're millennials in our 30s, and we're now living in Lisbon, and we've got passive income from our house. It's bullshit. It's social media dream that doesn't really exist, and that's never going to save him from £40,000 debt.
The work in real estate investment is learning the process. When I first started investing in real estate, it was a complete nightmare. And it was not passive, anything close to passive. It was a nightmare. What you don't know when you start is that there's a good property manager. There's also a bad property manager. How do I find good property managers? By going through a lot of bad property managers and learning the process. And that is a painful process, a very time-consuming process. But when you do have the right team, It can be extremely passive. So I invest in real estate.
What kind of properties are we talking about?
Single family houses and multifamily apartments.
And do you have lots of them?
Not lots, but I have a decent amount.
And how much of your portfolio is in buying properties and then renting them out to families?
50%.
So they're saying that passive income is BS here, and he's half right. There's no truly passive income under a 7-figure base. Rentals need oversight, dividends need capital, and businesses need operations. Passive income shows up after years of active building, but semi-passive is real and is achievable. My rentals aren't hands-off, but there's a lot less work than a day job while paying me every month. The difference is in systems. I document everything, every repair, tenant touch, and vendor policy into a simple playbook. And then I hand that playbook to a manager with a scorecard. Days to turn, delinquency rates, maintenance cost per door, vacancy days, etc. We meet once a month for 15 minutes, and that's how you turn headaches into checklists and then checklists into cash flow. The trick here is to build once, you systematize, and then you hand it off. It's not some magic formula, it's leverage. 1 hour of my time produces 10 hours of output because a system and a person can multiply it. So don't go chasing passive income, chase leveraged income. Turn recurring tasks into SOPs, bundle them into weekly batch blocks, and then automate the handoffs, and then pay the operators to press the buttons. The goal here isn't zero work, it's as little of your work as possible while the checks keep showing up.
I don't have a 401k, I don't have an IRA, but the reason why people like these accounts and why they can work for some people is because they are tax deferred accounts, meaning I can put my money in whether I pay taxes now or later. The money will then sit there, grow. I don't pay taxes until I pull my money out. But there's a couple problems. Problem number one, I have very little control over where my money can be invested. Maybe this will change. The Trump administration has passed a new executive order on 401ks to change what you could potentially invest in 401ks, but that hasn't happened yet. You have very limited options. They're primarily just mutual funds, and many of them have a fee. So if you don't know what your 401k fee is, this is your notice to go check what the expense ratio is, and you should know that. So you have very limited options. You're going to have to pay a fee, which means somebody on Wall Street is going to be paid forever until you retire. Number two, I can't touch this money until I'm 60 years old, 59 and a half. If I do, I have to pay a 10% penalty. And number three, the whole discussion is you're doing this for tax benefits. But kind of like we talked about earlier, there's a lot of tax benefits that you can get outside of a 401k, which is why you don't get to do anything with it. The government's going to be in charge.
Yeah.
This is what is running out of money in the United States today. Why? Because people that are in their 20s, 30s, and 40s that are paying into it today, it's not paying for their retirement, it's paying for the people who are retiring today, pay for their Social Security benefits.
And that's what people don't understand. They think they're paying into a piggy bank that they get to crack open and that will pay for them as long as they live for the rest of their life. I was looking at the biggest misconceptions around pensions, and the first one was that my pension is guaranteed money for the entirety of my life once I retire.
Well, there is some truth to that in the United States, at least, that you are guaranteed what the wording is that you're going to get the Social Security until you pass away. They never tell you, and there's no asterisk about this either, is how much that value of the check will be. So here's what's going on. People are paying into the Social Security fund, thinking that they're going to be able to fund their retirement. Every financial advisor historically has said that retirement is a three-legged stool. You have your 401k, your personal retirement, you have your own personal savings, and then you have Social Security. Well, you pay into Social Security by force because you don't get to opt out of it unless you are an investor. You don't have to pay your Social Security income or Social Security taxes on your investment income, but you pay into this until you hit retirement age, and then you get to pull this money out. Well, the government is running out of Social Security money, but people misconstrue that because they say, oh, that means the government's no longer going to pay Social Security. That's not true. They'll still pay it, but they'll just print their way to pay it, which is what you've been talking about.
They're talking about the family retirement systems here, and I do agree with a lot of this. But the key here is to not just treat it as your sole retirement, just use it as a supplement. Take the 401k match every single time. That's a guaranteed risk-free return. I pick the lowest cost broad index funds in the plan. So S&P 500 or total market, you set and forget it. And if there's a Roth option, I use it when I'm in a low tax bracket, and traditional when I'm in a high one. And if your plan has an HSA, that's the stealth IRA, contribute, invest it, and then pay small medical bills out of pocket so the HSA compounds. Here's my rule of thumb. You figure out what you need in today's dollars, you double it for inflation, and then 30% for healthcare, and then build 3 income sources that can each cover that number. One can fail, one can underperform, and you can still eat. For me, that's traditional investments, a business or rental cash flow, and a wild card. Bitcoin sits here as a hard money upside. Now look, these millionaires aren't wrong, they're just playing a different game. When you already have millions of dollars, you can swing for the fences and stomach a 100% crypto position. But if you're building from zero, you need a plan that still works when you're wrong. The path is simple, but it's not easy. Spend less than what you earn, you automate the difference, and don't touch it for decades. So start today, open the account, set the transfer, buy the position. Your future self will thank you. And tell me the one change you're going to make after this video, and then drop it in the comments. Like this video for the almighty algorithm, and I'll see you next week.